So you think a diabetes drug wouldn't threaten a candy company. Different industries, different customers, no obvious overlap. Sounds pretty obvious. It isn't turning out that way. Here's the part almost nobody understands about this business right now. A single class of injection is quietly rewriting demand for an entire category of food. Most people think snack companies sell taste. They don't, not entirely. What they actually sell is a craving, engineered to make you want more after the first bite. This single idea explains why one drug can shake an entire industry's stock price. You will see the scale of the drug boom and the mechanism behind it. You will also see the gap between what executives say in public and what their own numbers show. This is not really a story about medicine. It is a story about what happens when a business built on appetite meets a drug built to switch appetite off. Stay with me, because one company's own numbers make the case better than any outside critic could. The $300 billion side effect. Let's start with how big this has actually gotten. In just 1 year, the makers of Ozempic and a rival diabetes drug added something remarkable. Roughly $300 billion in combined stock market value in a single year. That surge was driven almost entirely by demand for weight loss, not diabetes treatment. Investors were not betting on insulin. They were betting on appetite itself becoming a solvable problem. Today, roughly 1 in 8 American adults has taken one of these drugs. More than half of all American adults are considered medically eligible to take one. Cheaper, compounded, and generic-style versions are already reaching a wider pool of patients across the country. Insurance coverage remains uneven today, but that gap is narrowing every single quarter. Analysts now expect usage to keep climbing as prices fall and coverage expands further. One widely cited forecast makes a striking claim. Patients on these drugs could represent over a third of all food and beverage spending within just a few years. That is not a niche trend confined to a small wellness crowd anymore at all. That is a large and growing chunk of the entire American grocery cart. Why this drug hit snacks specifically? Here's the part that sounds backwards until you think it through. These drugs mimic a hormone that signals fullness to the brain. That signal arrives earlier and lingers considerably longer than it normally would. Users report smaller portions and far less interest in snacking between meals. A Cornell University study found households with a user cut grocery spending by about 6% within 6 months. Savory snacks got hit hardest of all, falling as much as 11% in the same window. A separate industry analysis found GLP-1 users reduced annual calorie intake by roughly a fifth on average. Chips, cookies, candy, and sugary drinks all sit squarely in the crosshairs of that shift. These are exactly the products built to be highly craveable and easy to overeat. Even bread makers are reporting softer demand as shoppers cut carbohydrate-heavy staples too. The drug does not target one brand or one company. It targets the entire psychological mechanism the whole category was engineered around. The trap of believing your own spin. Here's the trap hiding underneath this entire situation. On earnings calls, food company executives have mostly stayed calm in public. One major snack CEO called the long-term impact a rounding error, somewhere around 0.5% of sales over an entire decade. Another executive said the company has seen very little direct impact so far. Investors listening to these calls want reassurance, not alarm. A confident tone can hold a stock price steady even when the underlying trend is real. The official message to investors is steady. Nothing to see here. The actual numbers tell a rougher story. One major snack maker has now posted 5 consecutive quarters of declining volume in its savory snacks division. Another has seen North American revenue drop over 4%, with executives pointing to shoppers switching toward eggs and lean protein instead. A well-known soup and cracker maker recently lowered its full-year sales forecast after cookie and cracker sales failed to rebound. A company that calls the risk a rounding error, while its own category keeps shrinking quarter after quarter, is making a bet. That bet is that the story is temporary. If it isn't, the gap between the message and the numbers gets harder to explain every quarter. The company whose numbers stopped hiding it. Meet the Hershey Company. For most of 2024, the company described the impact from these drugs as mild. The actual results told a sharper story. North American salty snacks net sales fell more than 15% year over year. Volume and mix within that category dropped 17% in the same period. The company's classic chocolate and candy lines were not immune to the same pressure either. For a company that had projected steady, low single-digit annual growth, that gap is not a rounding error. Hershey stock drifted down for much of the year, eventually touching a 2-year low. Not every part of the business moved the same direction. Some smaller, premium product lines actually held up reasonably well during the same stretch. Executives pointed to broader pressures too, including inflation and cautious shoppers. Untangling exactly how much of the decline came from the drug itself is honestly difficult. The categories hit hardest were precisely the ones these medications are designed to suppress. That alignment is hard to wave away as coincidence. The company's betting on reinvention instead. Not every company is treating this as bad news to manage quietly. Some see a real opportunity hiding inside the disruption. One frozen and packaged food company has openly positioned certain product lines as a natural fit for GLP-1 users. It now markets small portions and lean protein directly to that audience. Major snack makers have started rolling out higher protein, higher fiber versions of their most popular products at the same time. Protein-boosted chips, fiber-rich popcorn, and reformulated sports drinks have all launched within the past year. Smaller portion sizes and single-serve packaging are showing up on more grocery shelves too. The bet behind all of it is straightforward. If appetite itself is shrinking, the fight moves to what little appetite remains. Companies that adapt their actual product line have a path forward. Companies that simply wait and reassure investors are betting the trend fades before the damage compounds. The real odds of selling snacks now. In the optimistic scenario, a company reads its own numbers honestly and reformulates fast. New protein and fiber lines capture the same shopper under a different set of cravings. In the realistic scenario, a company keeps telling investors the impact is minor, while its core category keeps shrinking. By the time the public message catches up to the real numbers, competitors have already claimed the new shelf space. Every packaged food company on earth is quietly running the exact same calculation right now, whether they say so publicly or not. Ozempic was never really built to compete with candy bars. It just happened to switch off the exact craving that candy bars were engineered to trigger in the first place.